So I'll pause here for a second. Any questions? So now on the book slides, we talked about all of it. So we're skipping through. Where does the company spend its cash? We've talked about distinguishing. You can look at these slides and kind of use them, but I think my slides are better. So I wouldn't really focus on these. So we're going to go to preparing the statement of cash flows now. Kind of skipping to, so how do we prepare the statement of cash flows? So step one, we compute a net increase or decrease in cash. How do we do that? It's just on our balance sheet, right? Like our balance sheet will show us what our period was last year, what our cash balance was last year, and what our cash balance was this year. And that'll be our difference. Then we'll figure out operating activities, investing, then financing. And then we just make sure that that ending balance agrees to our balance sheet and our bank statement. And so using the direct method, we'd go to that cash account and then classify everything. I'm going to teach you more the indirect method, but we could look at our cash accounts and say, oh, here's all of our payments for inventory. Oh, here's all our payments for wages. And in your homework, you'll be given those numbers to you if you need to use the direct method. But the indirect method is what we really need to focus on, which is using non-cash accounts. So a second approach to prepare the statements of cash flows is analyzing non-cash accounts. That's what we really use in practice, called the indirect method. So to do this, we just look at our balance sheets and our income statements from over the last year, and we see how they changed. And so, for example, if inventory goes up $10 million, we know that we spent cash on it. So our cash goes down 10 million in our operating activities. And we talked about, we've done these slides, kind of bucketing them off. Don't need to focus on that. And these are the difference. This is kind of how the different presentation of direct method versus indirect method. Direct method is just useful from conceptual understanding. Like we'll actually look at the bank statement and cash balances and say, hey, here's all our cash received from customers, $570,000 or million. And then we'll get to our net cash at the end. Indirect method, which almost everyone uses, is the net. We take the net income, that total amount, and then we do a reconciliation where we say, oh, accounts receivable increased. Because accounts receivable increased, we know that we didn't receive cash for those sales that were recognized. And so we decrease our cash flow because that income wasn't collected as a portion of cash. And we go down the balance sheet and then make a reconciliation at the bottom. These numbers will always be the same. We get the same conclusion. It's just a different way of getting there. So let's focus on how do we do the indirect method, because that probably was super complex for super complex thought. It's really a lot easier than you think. All we do is we take the differences. So you just take here, the 2017 and 2016, and you'll make a difference. So 17,000 minus 12,000, that's $5,000 increase. $20,000 increase, 14,000. You just take the difference for all your balance sheet accounts. And then you have your income statement. And then you take these differences and you'll adjust your cash flows related to them. So the logic behind it is like accounts receivable, there's a logic behind it. If our accounts receivable increases, then we didn't collect cash for that sale. And so we decrease our cash flows. But there's also a convention you can use where if it's an asset, if it goes up, it means we didn't get cash for it. So it goes down. The cash goes down. If it's a liability and equity, they reverse. If liability goes up, then we got cash for it, it goes up. If liability goes down, we spent cash for it, it goes down. So there's two ways you can kind of look at this. So how do we apply the indirect method of reporting? Wait, that's pretty much it. Let's see. Net income, changes in non-cash, and we're going to get the cash flow. So I want to do an example. This slide might be useful. That's what I was trying to get at. An increase in current assets, we subtract from net income, and an increase in current liabilities, we increase in net income. While a decrease, so the current assets are inverse of what you'd think, and then the current liabilities are correlated. This makes sense, right? If our liabilities go up, it means that we borrowed money probably. So we have more cash. That's the logic behind it, even if it seems counterintuitive. If our assets go up, we probably spent money on it. It goes down. Income goes down, or the cash flow goes down. So there's adjustments for changes in current assets and current liabilities. Any non-cash expense has to be reversed as well. What do I mean by non-cash expense? Things like depreciation, losses, and gains need to be reversed from the statement of cash flow. Why? Do you spend any cash on depreciation? No, right? We capitalize our asset on day one. That's when we spend the cash, right? We might buy a $100,000 car. On day one, that's when we spent the cash. 100,000, that'd be a $100,000 cash outflow for investing activities. But now we depreciate that car for 5 years or whatever the useful life is. We went over that in the depreciation class. That depreciation expense is non-cash, right? We never spend cash on that depreciation. It's just a convention used for accrual-based accounting to have expenses match to our income based on the matching principle. So the depreciation expense has to be reversed out of income to get our operating cash flow. So if we have a depreciation expense of $24,000, we add it to our statement of cash flows. We add $24,000 because it's a non-cash expense. Same thing with losses or gains. All right, if I sell that car 3 years later and I have a loss on it of $6,000, is that a cash loss? No, I still receive the cash today for whatever that car is, and that's an investing activity. The loss is truly just an income statement. It's an accrual-based loss. So we reverse it out. Same thing with gains. So a gain will actually decrease our cash flows. Understanding this stuff, right, this is where it really comes together. When we really understand this, we can really get how businesses run. So you can see here, we just use those convention. If we have an increase in accounts receivable, so we saw, this ties back to up here, of 20,000, we reduce our operating statement of cash flows. Increase in accounts receivable will decrease it. If it was a decrease in accounts receivable, it would increase because it means we collected the accounts receivable. Increase in inventory means we bought inventory. We saw that on the Tesla. Increase in prepaid expenses, right? We prepay the expenses. It's an asset. It increases. That means that we spent the cash on it, so it goes out the door. That would decrease our cash flows. And you get the rest here. A decrease in accounts payable means we paid for the payable. It's a liability, so it goes down. Our cash flow goes down. If our liability is increased, it means we didn't pay cash for it. So we would increase it. So make sure you kind of really understand the concepts of the increases and decreases. And if it's a lot for you, at least memorize this slide. Right? Memorize a slide that if the account balances change during the year, if it increases during the year, at current asset increases, you get the reverse. Or if it decreases, you get the reverse. But for liabilities and equities, it's correlated. So you can see here, this is how we'd get to our operating activities. We take the first step, then income statement items not affecting cash. So that's going to be our depreciation and our losses and gains. If we have amortization too, that's where we put our amortization. And then we have changes in current assets and liabilities. That'll be the inverse, right? Assets will, if an asset goes up, you'll take cash flow down. If your liability goes up, your cash flow will go up. And then that's how you get your operating activities. You take your net income, and then you add and subtract all these numbers to get your operating activities. And so you can use this slide as your summary of adjustments, right? You take your net income, total net income, then all your non-cash expenses and losses, revenues and gains, so the depreciation, gains and losses, and then adjustments in current assets and current liabilities. And so this is an example here. If we get this information, how do we do it? And so we can do that together. So you can, where's our notes? Statement of cash flows. And so I'll prepare this with you so you kind of get the gist. So we'll do our balance sheet. AR, inventory, AP, SP, salaries payable, interest payable. Then we have our current year, our prior year. 12, 6, 7, 8, 1, 10, 9, 11, 3, 0. And then we just take our difference. So how did it grow? AR went up that amount. Those are our changes, right? Then we also have income statement. We have to see our non-cash activities. Non-cash interest and expense. Income statement. Sales, cost of goods sold, depreciation, salaries, expense, interest expense, net income. So 120, 50, 30, 17, 3 equals this minus this minus this minus this minus this. We have $20 in net income. So how do we make our statement of cash flows? You take your net income of 20. That's what you start off with. Then we see non-cash expenses or gains. And what do we have? We have depreciation, right? So we'd add back the depreciation. That's non-cash depreciation. We had a gain or a loss, right? The gain we would reduce, the loss we would increase. And then we would then take all of these accounts, AR, inventory, IP and everything. And then we just take the reverse of it, right? If we have an increase in AR, it would be a decrease because they're short-term assets and for the assets. And then for liabilities, we take the correlated version, right? So the payables, we take the direct amount. For the assets, we take the inverse. And then we'll get our statement of cash flows for operating activities. Just the sum of all of these. Let's see if I actually got that right. Let's see. 53. So that's what all these slides are saying, right? This is just showing you what I showed you, how quick the calculation can be. So I'm going to show you, it can be overwhelming, like all these new concepts. It's really not that bad, right? We just take the difference, how the balance sheet's changed. We take the income statement. We start with our net income. We back out any of the non-cash expenses. And then for the asset accounts, we take the inverse of the change. And for the liability accounts, we take the correlated amount of the change. And then we get our operating activity cash flows. And now you have the calculation in there as well. Luckily, investing in financing is a little easier. Because related to these, we actually have to, we can't do any true reconciliation. We can kind of see how it changes, but we also have to understand how the accounts moved. And there's a lot less accounts. So we do a reconciliation, but you kind of also have to understand, like, read the documents. And so the plant assets, right? Because this increase in plant assets, it's not so simple. The increase in plant assets, we can't just reconcile it because that might include disposals, right? It might include depreciation. This number includes a lot of information. And so we actually need to get some kind of reconciliation or some other report. We can't just use the balance sheet. And so the analyst reveals a $40,000 increase in plant assets. But this also includes a $12,000 increase in accumulated depreciation. We'd need to consider that, right? So the cash flows from investing, we'd want to see what happened there. This number bakes in all the other pieces. And so we would see here, we purchased assets of $60,000 on a notes payable. That would be a non-cash disclosure. And then we sold plant assets we sold these plant assets where we got a $2,000 loss on the sale. And we also had this depreciation expense related to it. So all of these would go into our statement of cash flows, just like, oh, sorry, I'm going to sneeze. Or I lost it. All of these will go into your statement of cash flows. And so know that, like, that balance, man, I got a sneeze coming and it's just, It's so frustrating when it doesn't happen, you know? All right. So, okay. Oh, man. Okay, so all of the accounts can include this. Like that's plant, property, and equipment includes all of these transactions. So you have to think critically when you're looking at it. And your homework and your quizzes will kind of give you those transactions so you can work it out, right? And so we can kind of use an example here. So what happens if, to determine the cash flows from investing activities, what if we have a factory of a book value of 100, an original cost of 800 that was sold at a loss of $10. We paid $70 cash for new equipment. We have these long-term investments. We can kind of go through how all of them will look. And so if we have a factory with a book value of 100 and a cost of 800 that was sold at a loss of 10, we can say cash we received 90, loss is 10. That's the information given. We know the factory is 800, so we have accumulated depreciation of 700. That's the plug. And so this loss would be adjusted on the non-cash expenses, right? We'd add back in this section over here. It'd be added back as part of similar to depreciation. And then we'd have on our investing activities, we'd have cash received of 90. Because that's actually the cash we got. So on the homework, you might get a question like this, or on the final, I might have a question like, how would this loss be presented? I'm not going to ask you to create a statement of cash flows. That's going to be your intermediate class, your next financial accounting class. But I'm going to ask you, how is this loss classified? Okay, I see there's a question. So for some reason, the functionality in Zoom, it doesn't let me see the chat unless if I'm sharing, which is a little frustrating. Okay. No worry. If you had, no worry, Ben. Okay. No worry. Okay. So all I'm going to ask you about is these specific transactions. I'm not going to ask you to calculate. I might ask you to calculate operating activities because that's what we've gone over. But for these more complex, I'm not going to ask you to figure out like what's the total statement of cash flows or calculate it independently. You're going to have to do that for your homework, but for the final, you're not going to. I just want you to make sure you know that, hey, the loss here is going to be on operating activities, and it's going to be an increase or decrease. The factory will be, the cash we receive is going to be our investing, and is it an inflow or outflow? We paid $70 for new equipment. We know that's going to be $70 for new equipment, right? That's going to be an outflow on the investing. It makes sense if you don't try to overthink it in your head. If we sell long-term investments for $20 and we get a loss of 4, the 20 goes on our long-term investments, our cash outflows. And then the 4 is our loss, which is a non-cash, like depreciation. It adjusts our operating cash flows. So just kind of know where they land. And if we sold land for $175 for land costing $175 for $160 cash, and we have a loss of $15, the $15 loss is added back to operating, and then our cash received is added to investing. And then so our cash flows from investing are 90 plus or minus the 70, that's 20 plus the 20 here, plus the 160s, which are our 200. And then these will change our operating activities. Financing is similar, right? We have to really understand the underlying pieces of the transaction to do it correctly. So long-term notes payable may increase here from 64 to 90. It increased $26,000. But does that mean that we retired some of the debt? Did we add more debt? We have to really read the underlying transactions to understand. And so in that statement, we might have a gain on the retirement of debt. We might have paid some cash for it. We might have gotten some more. And so we have to look and understand the journal entries to really break it out. And so we'll do the example here to explain it better. So use the following information. How is the financing activities altered? Well, if we issued common stock for $40, that's going to increase our activity. And then we paid $70 to retire a note payable at 70 maturity. That's going to be a cash outflow, right? We paid off on notes payable. We paid out dividend, and we bought treasury stock. And then this would be our net balance for our financing activities. And this is just a summary using the some are using T accounts, how you can see it, how it all works out. So I'll let you do that yourself. That's really all I'm expecting out of you. The last piece is just analyzing statement of cash flows using a total asset ratio. I'm not going to spend too much time on the total asset ratio. You just know that cash flow is pretty important, right? I personally care more about cash flow for small businesses and my investments. Cash flow is just as important to me as all the other statements, if not more important. So just know that we can determine cash flow on total assets by taking operating cash flow and dividing it by the average total assets. That's just a formula you have to learn, right? And so by doing that, we can figure out how well they're generating cash based on their assets. So this is similar to like your return on assets ratio. And we've already done this illustrated example using a spreadsheet. I just did that with you all. And I don't want you to learn the direct method. In all my years of accounting and finance, I've only used it for small clients. I've never used it for any of my multi-million or billion-dollar clients. So I don't think it's that important. You might have to do it for your intermediate class just so you understand the concept, but I don't want you to learn this class. Just understand the indirect method, main takeaway, understand indirect method, make sure you understand how to do the operating like we did here, and understand those real key takeaways from my other slide, right? I really want to make sure you get this information. Like, how is it classified and how is it reconciled? That's really it for statement of cash flow. It's really going to be a practice thing. So I'm going to stop here and make sure that, stop recording.